Hello and welcome to the latest episode of Damien's Market Update, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, before I start this show, as ever, if you find any of this at all interesting or useful, then please make sure you hit that like button and also subscribe to the channel because it helps us promote what we're doing and help more people with their finances and their investing. So last month's show was titled Looking to Central Banks for Direction, which was apt given that June was characterized by intense volatility, mostly centered around the monetary policy announcements from major central banks, most notably that of the US Federal Reserve. But it was perhaps the European Central Bank, the ECB, that surprised investors the most since my last show. Ahead of the ECB meeting on the 9th of June, investors anticipated a continuation of the central bank's more dovish approach when you compare it to that of the Federal Reserve in America and our very own Bank of England. However, this time President Christine Lagarde turned surprisingly hawkish, confirming that the ECB would increase interest rates for the Eurozone by 0.25% in July, followed by a potentially larger hike in September if economic indicators supported it. Now, the shock led to a sell-off in European equities, with the Stock 600 tumbling and ultimately finishing June down around about 9%. But some of the more worrying moves occurred in bond markets as borrowing costs for the more heavily indebted Eurozone countries hit an 8-year high. Now, if you look at the spreads between core and peripheral countries, these widened, with the Italian-German spread, which is a standard indicator of the stability in the region, that hit a level not seen since April 2020. And this threatened to send the Eurozone into another European debt crisis, as we saw back in 2010. And who would have predicted at the start of June that's where we would be? Now, the situation escalated so quickly that the ECB was forced to call an emergency meeting to deal with the impact of its decision to start withdrawing monetary support. And the result of the meeting was an as yet unfinalised bond buying plan, which resulted in a rally in bond markets, putting yields back on a downward trajectory. But until more details emerge, there remains a very real risk that markets could fly into a panic once again. But by mid-June, markets were in turmoil again ahead of interest rate decisions from the Federal Reserve in America and the Bank of England, which occurred on the 15th and 16th of June, respectively. Now, the former opted to hike rates by 0.75%, while the Bank of England put its base rate up by 0.25% to 1.25%, which is the fifth increase in a row, with inflation hitting 9.1%. But the final weeks of June could well be remembered as the point when the market narrative pivoted dramatically, setting up a potential change in market direction for the second half of 2022. Now, if you recall, at the start of June, stagflation was the buzzword in markets, so that's slowing growth alongside inflation. And at the time I explained it was the interaction between market fear of inflation versus fear over a lack of economic growth that would likely change the market trends we were seeing at the time. Now, back then, the fear of inflation was hurting bonds more than the fear of slowing growth could support them. And I reasoned that as soon as investors began thinking inflation had peaked, then we shouldn't be surprised if we saw a rally in bonds as economic growth fears took centre stage. Towards the end of June, the threat of inflation was in fact usurped by the rising risk of recession. And this was compounded when the Fed's chair, Jerome Powell, explicitly stated that the move to raise interest rates to tackle inflation could cause a recession. The fear of recession gripped markets, and bond markets in particular, and we saw the 10-year US Treasury yield fall from 3.5% to 3.06% in a matter of days. And since then, the 10-year US Treasury yield has actually fallen below 3%. Moves like this were replicated in bond markets outside of the US as well, and investors began hedging against the possibility of a recession. For equity markets, though, it brought about a bleak end to a challenging month, with the S&P 500 ending June almost 8.5% down on the previous month. The Nasdaq Composite, which has a higher weighting to tech stocks, also fell by a similar amount across the month. Now, the continued slump in equity markets means that June brought to a close one of the worst starts to a year in more than 50 years. But not only that, but a typical 60% equity, 40% bond portfolio was down around 11% in the first half of 2022, one of the worst starts on record. Now, going into June, commodities had been one of the best performing asset classes so far in 2022, but the surge in recession fear saw most commodities enter bear markets during the month. The slump in commodities hasn't been grabbing headlines, but maybe that isn't surprising given that despite the 20% slump in the price of oil during a 2-week period in June, the price was still up over 40% come the end of the month. But it was the strong price moves in copper that gained my attention, and I dedicated part of Sunday's podcast, if you recall, to explaining the importance of copper as an economic indicator. Suffice to say that Dr. Copper is clearly concerned about the health of the global economy and the increasing likelihood of a recession. One bright spot in equity markets were Chinese equities as COVID restrictions were eased and monetary policy was loosened in China. And while Chinese tech stocks staged a recovery thanks to fewer interventions from the government, it certainly means it's something to watch going into July. So keep an eye on Chinese equities. Meanwhile, the pound has fallen to a 2-year low against the dollar at $1.19, which wasn't helped, of course, by political events which resulted in Boris Johnson resigning. Now, will the downward pressure on the pound continue? It is also important to keep an eye on bond yields going forward for signs that the bond bear market might be finally over if we see recession fears take hold. Now, don't just look at the fall in bond yields if it happens. Also look for signs of the yield curve inversion, which is where you see the yield on short-term government debt being higher than longer-term equivalents. And we're already seeing that in the US, but do look to see if it continues and if we see it elsewhere as well. Now, does that mean we are now going to see defensive equity sectors start to outperform? So things like healthcare, utilities and consumer staples start to outperform more cyclical sectors such as energy that have been the best performers so far this year? And what of the ECB's rescue plan to effectively save the euro? And will central banks carry on tightening monetary policy to combat inflation and risk a global recession? Or has inflation already peaked? These are all things that we need to look out for in July. And whichever way you look at it, it still very much feels like commodity prices are going to prove key in determining what's going to happen next. So that is it for this episode of my market update. As ever, do ask questions in the comment section below and I will come back to you on those and try and add further insight. If you've enjoyed this video in any way or found it helpful, please do make sure you like it and subscribe to our YouTube channel, and do make sure you follow us on our other social media channels.